Welcome to another deep dive.
Glad to be here.
Yeah, so today we're looking at this stack of incredibly dense, heavily annotated notes,
Very dense, right?
sourced directly from the CA final textbook, the Advanced Auditing, Assurance, and Professional Ethics one.
Oh, yeah. The heavy hitter.
Exactly. And, if you are anywhere near this material, whether you're like in the final grueling stretches of exam prep,
Good luck to you if you are.
seriously.
Cool.
Or maybe you're a professional gearing up for a high-stakes board meeting, where liability and assurance levels are going to be heavily debated.
Right.
Then you know exactly what we are up against today, because we're basically looking at the foundational architecture of financial trust.
We are. And I think the immediate barrier to entry with that architecture is the nomenclature.
The jargon.
The sheer density of the jargon. I mean, you're dealing with an entire ecosystem of acronyms and these four-digit codes that, honestly, on the surface seem designed to obfuscate rather than clarify.
Oh, totally. It's like an alphabet soup, but, an alphabet soup with massive legal consequences. You have your SRSs, your SREs, your SAEs, they all carry these complex numerical designations.
Yeah, and when you're staring at a prospectus.
Or an engagement letter.
Exactly. The difference between, say, an SRE 2400 and an SRE 2410.
Might seem purely pedantic.
Right, like who cares? It's just a 10. But as the notes make incredibly clear, confusing those two could lead to a catastrophic misunderstanding of risk.
It's huge. So today is about building professional mental models.
Yes.
We aren't just going to read textbook definitions of these standards. We're going to break down the specific memory techniques, the cognitive hooks.
The things that will actually allow you to lock these concepts into your working memory permanently.
Exactly. Our mission is to make this stick.
And it helps to visualize the space we're working in. If you
Yeah.
look at the material and you can just imagine the sheer volume of ledgers and corporate filings sitting behind these standards.
Mountains of them.
Right. You realize they aren't isolated rules. They exist on a very deliberate, continuous spectrum of trust.
A spectrum.
Okay.
Yeah.
Yeah, we're going to trace a sliding scale that begins at absolute zero assurance, moves up through limited assurance, and eventually scales all the way up to vouching for the future.
And relying on complex third-party infrastructure.
Precisely.
Well, I want to start right at the bottom of that spectrum before we even, touch a full audit.
The zero assurance zone.
Right. We have to look at what happens when a practitioner is hired to do professional work, but explicitly refuses to offer any assurance.
The notes categorize these under related services.
Specifically, the SRS standards.
Right. And to contextualize why related services matter, you first have to define the baseline of what they are not.
Which is...
They are not assurance engagements. The textbook defines an assurance engagement as a scenario where a practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users.
Okay, so you're taking a subject matter, evaluating it against a strict set of criteria, and basically putting your professional reputation on the line.
Yes, you're saying this is reliable.
You are providing a shield for the user.
Exactly.
But wait, if an SRS engagement provides absolutely zero assurance,
Zero.
if the practitioner is not expressing any conclusion to enhance confidence, why would a massive corporation spend hundreds of thousands of dollars to hire a Big Four accounting firm to do one?
It's a great question.
What's the actual business value if you don't get that shield?
That is the crucial friction point right there. Because the value isn't in the professional opinion.
Okay.
The value is in the execution of highly technical, objective tasks.
I see.
The client doesn't need a broad shield. They need a surgical instrument. They need someone with unimpeachable technical skill to perform a very specific action.
Without the overhead and time of a full audit.
And a massive expense. Exactly.
Okay, let's unpack this. This brings us directly into the mechanics of SRS 4400.
Engagements to perform agreed-upon procedures.
Right. And I was reading through the parameters of this standard, and it essentially strips the auditor of their traditional role as a judge.
Completely.
In an SRS 4400 engagement, the practitioner, the client, and maybe any relevant third parties, they basically just sit down and negotiate a literal checklist of tasks.
A very strict checklist.
Like the client might say, we're acquiring a smaller competitor, and we just want you to physically go to their warehouse and count the inventory. That's it.
Right. Just count the boxes.
So the practitioner executes that specific checklist and reports the factual findings. No true and fair view, no subjective opinions.
Just raw data. The toolkit is completely restricted here.
Because you aren't offering an opinion.
Right. Because you are not offering an opinion, you are explicitly forbidden from utilizing complex, subjective auditing judgments. You cannot extrapolate.
You can't say, well, based on this inventory, the whole company is healthy.
Exactly. You cannot assess the overall health of the internal controls unless that was specifically one of the agreed-upon procedures. You are confined entirely to the facts.
And the notes highlight the specific procedures that are actually permitted under SRS 4400?
Yes, and this is where we need our first mental model.
Definitely. The framework to anchor these procedures is the acronym IROIC.
IROIC.
Right. You can pronounce it IROC.
It sounds a bit colloquial.
It does, but, when you are trying to differentiate permitted procedures under immense pressure in an exam,
It works.
it really works. When you execute an agreed-upon procedures engagement, you shed the heavy burden of an audit opinion, you simply execute the checklist, and you say, IROIC.
I love that. Let's dissect the components of that framework based on the text.
Okay, go for it.
The I stands for inquiry and analysis. The R is for recomputation, comparison, and other clerical accuracy checks.
Okay.
O is observation. The second I is inspection, and C is for obtaining confirmations.
So, IROIC, inquiry, recomputation, observation, inspection, confirmations.
Right. And if you look closely at the nature of those 5 actions, you'll see a profound commonality.
Which is?
They are entirely objective. Recomputation is purely mathematical.
You're just checking if the spreadsheet actually sums up correctly.
Exactly. And observation means you are physically watching a process unfold, like watching the client's staff conduct an inventory count.
Right.
You are not evaluating if their inventory counting method is the most efficient in the industry.
Or if it perfectly guards against shrinkage.
No. You are simply stating, I observed the staff counting the boxes on Tuesday.
You are acting as a highly trained set of eyes and a calculator.
Pretty much.
But I want to push back on something in the notes regarding the reporting of these findings.
Okay, what's that?
SRS 4400 mandates a strict restriction on who gets to see the final report.
It does.
It can only be distributed to the parties who explicitly agreed to the procedures during the planning phase.
Sure.
But isn't that inherently secretive? If a company hires a prestigious firm to verify their accounts payable and the results are perfectly clean, wouldn't they want to publish that report to reassure the market?
You would think so.
So why force them to hide it?
Well, it isn't about secrecy. It's about the severe danger of implied assurance.
Implied assurance.
Think about how the market consumes information. If a retail investor, or even a sophisticated institutional lender, sees a beautifully bound report from a top-tier accounting firm with the title, Accounts Payable Analysis.
Human psychology immediately kicks in.
Exactly. They see the firm's letterhead and subconsciously assume the firm is vouching for the financial health of the company.
They assume the halo effect of the audit firm applies to the whole business.
Yes. They won't read the fine print stating it's an SRS 4400 engagement with zero assurance. They will mistakenly rely on it as if it were a full audit. So by legally restricting the distribution of the report strictly to the parties who sat in the room and designed the procedures, the standard protects third parties from their own dangerous assumptions.
It ensures that the only people reading the raw data are the people who fully understand its limitations.
Exactly.
That structural safeguard makes perfect sense. It contains the blast radius if someone tries to misinterpret the data.
That's a great way to put it.
Now, let's look at the other side of the zero assurance coin. We have SRS 4410.
Which governs compilation engagements.
Right. Let's move away from basic analogies and look at how this functions in complex corporate environments.
Okay.
Imagine a parent company that has just acquired 3 disparate subsidiaries. Each subsidiary uses entirely different legacy accounting software.
A nightmare scenario.
Right. Management has a mountain of raw financial data, ledgers, disjointed records, and they need it synthesized into a coherent, standardized set of financial statements.
So they hire a practitioner under SRS 4410 to do this.
Exactly. The practitioner applies their deep expertise in accounting and financial reporting frameworks to structure and format this data.
But the critical boundary here, the absolute line in the sand, is that the practitioner does not verify the underlying veracity of that data.
Precisely. They are structuring the data, not auditing it. It's like assembling IKEA furniture.
IKEA furniture.
Yeah. The client hands over the pieces, the financial data, and you just put it together. You don't check if the wood is rotten.
That's actually a very accurate analogy.
And the mental model the notes provide for this is, Compile, don't profile.
Compile, don't profile. It's a very effective professional shorthand for defining the scope of liability.
Right.
The practitioner's mandate is to take the records, documents, and explanations provided by management and compile them. You're explicitly not profiling the data.
Because profiling implies investigation.
Exactly. It implies you are gathering corroborative audit evidence, assessing internal controls, or hunting for fraud. Under SRS 4410, you are doing none of those things.
You are an architect assembling the building materials exactly as they were handed to you.
Yes.
Compile, don't profile. It sounds straightforward, but walking away from a paying client because their bookkeeping is messy seems overly punitive.
Yeah.
Where is the line between messy data that you just compile and data that forces you to take action? The notes say you don't profile, but surely you can't just blindly compile blatantly fraudulent numbers.
You've hit on the core ethical tension of SRS 4410 right there.
Okay.
Even though you're operating in a non-assurance environment, you are still bound by the fundamental principles of professional ethics. You cannot leave your professional skepticism entirely at the door.
So what do you do?
The standard dictates a specific escalation protocol. If, during the compilation process, the practitioner becomes aware that the records provided by management are incomplete, inaccurate, or otherwise unsatisfactory.
They can't just proceed.
No. They must pause the engagement, bring the issue to management's attention, and formally request corrected or additional information.
And what happens when you are dealing with an aggressive management team?
How so?
Let's say the CFO says, look, we know the revenue numbers from the new subsidiary are estimates and highly aggressive, but we need the compilation done by Friday for a board meeting. Just use the data we gave you.
That is where the practitioner's liability shield turns into a hard wall.
Really?
Yes. If management refuses to provide the necessary corrections, the practitioner must propose appropriate amendments to the compiled financial information to prevent it from being materially misstated.
And if management declines to accept those amendments?
The practitioner has no middle ground. The standard mandates that they must withdraw from the engagement.
Wow, just walk away.
Furthermore, they are required to inform management and those charged with governance of the exact reasons for the withdrawal.
So compile, don't profile doesn't mean compile and ignore the smell.
Not at all.
You can't be complicit in presenting a fundamentally broken financial picture, even if your signature explicitly says no assurance. You can't let your professional standing be weaponized to lend credibility to garbage data.
Precisely. The ethical floor remains solid, regardless of the assurance level.
Okay, that covers the related services. We've mapped the zero assurance territory.
Yes.
But what happens when a client needs more than just a compilation or a factual checklist, but they still can't afford or don't have the time for a massive traditional audit?
This brings us to the middle ground of the trust spectrum.
Review engagements, governed by SRE 2400 and SRE 2410. We are now entering the realm of limited assurance.
The distinction between limited assurance and the reasonable assurance provided by a full audit is one of the most frequently misunderstood concepts in corporate finance.
Oh, I bet.
It is vital to understand the difference in depth and rigor.
The way I think about it, translating the notes into a practical framework, is looking at the methodology of investigation. A full audit is like a full-body MRI. It's an exhaustive forensic examination. The practitioner is testing internal controls, sending out external confirmations to banks and debtors, physically verifying assets.
Performing deep substantive testing on individual transactions.
Right. They are actively hunting for material misstatements. It is incredibly resource-intensive.
Very.
A review engagement, however, is significantly scaled back. It's more like a doctor asking how you feel and checking your temperature.
That's a good way to look at it. The practitioner is not doing deep substantive testing or hunting for fraud. They are taking a higher-level view, assessing the overall plausibility of the financial statements.
And because the scope of procedures in a review is so drastically reduced, the practitioner's ability to express confidence is proportionately reduced.
Exactly. They cannot issue a positive opinion. They cannot sign a document that says, in our opinion, these financial statements present a true and fair view.
Because they simply haven't gathered enough evidence to make that affirmative claim,
Right.
Which leads to one of the most fascinating quirks in the entire auditing profession.
The negative wording.
Yes, because they can't give a positive opinion, they rely on negative assurance.
Yes, the negative assurance conclusion. In an unmodified review report, the practitioner will state, Based on our review, nothing has come to our attention that causes us to believe that these financial statements do not present fairly, in all material respects, the financial position of the entity.
Nothing has come to our attention. It sounds almost passive.
It does sound passive, but the legal weight of that phrasing is massive. Let's really analyze that maneuver.
They aren't guaranteeing the financials are flawless. They are shifting the paradigm entirely.
It is a brilliant mechanism for managing liability.
Oh.
By stating, nothing has come to our attention, the practitioner is explicitly defining the limits of their responsibility.
Okay.
They are telling the user, we performed the moderate, high-level procedures required by the review standard. Based only on those specific procedures, we did not stumble across any glaring errors or red flags.
It protects the practitioner from being sued if a deeply hidden sophisticated fraud is later discovered.
Exactly. Because a review is not designed to uncover deep fraud. At the same time, it provides the user with a meaningful, albeit moderate, level of comfort.
It signifies that an independent, skeptical professional has interrogated the data and found it internally consistent and plausible.
Correct.
It's the professional equivalent of saying, we walked through the house and we didn't smell smoke, but we didn't rip open the walls to check the wiring.
That's a great analogy.
So how exactly do they check for smoke without ripping open the walls? If they are skipping all the heavy substantive testing, what are the actual core procedures of a review engagement?
The notes distill this down to a very tight framework.
The mental model here is simply INA.
Inquire and analyze. Those are the twin engines of a review engagement.
INA. Whenever you are assessing the scope of a review, you default to inquiry and analytical procedures. You aren't doing three-way matching of invoices.
No, you are asking questions and looking at the math.
But let's dig into the reality of that. How robust can inquiry actually be? Isn't it just asking management if everything is okay and management saying yes?
Well, if executed poorly, yes. But the standard demands professional skepticism during inquiry. Inquiry isn't just a casual conversation.
What is it then?
It is a targeted interrogation of management's intent and methodology. You are asking complex questions about their accounting estimates, the justification for changes in accounting policies, the existence of complex related party transactions.
Their formal assessment of the entity's ability to continue as a going concern.
Exactly. You are looking for hesitation, inconsistencies, or answers that contradict your broader understanding of the industry.
Okay.
The standard notes that evidence obtained through inquiry is often the principal source of evidence about management intent, which is incredibly difficult to test substantively.
And the A in INA analytical procedures acts as the counterweight to those inquiries.
Right.
Let's say management tells you that their new sales strategy has been incredibly successful. You use analytical procedures to test the plausibility of that statement.
You aren't checking individual sales receipts.
Right. You are looking at the trend lines. You compare the current month's gross margin to the historical average or to industry benchmarks.
Exactly. You are identifying variances from expected values. If management claims stable operations, but your analytical procedures reveal that inventory turnover has suddenly plummeted while days sales outstanding has skyrocketed,
you have a massive inconsistency.
the analytical procedures flag the anomaly.
And when you find that anomaly, you pivot back to inquiry. You said things were stable, but the math says your inventory is stagnating. Explain this.
Yes, it's an iterative loop of INA until the practitioner is satisfied that the financials are plausible.
Now, the notes split review engagements into two distinct standards, SRE 2400 and SRE 2410. For anyone trying to keep these straight during an exam or a regulatory compliance audit, they can easily blur together. We need a way to instantly differentiate them based on the relationship between the practitioner and the client.
The differentiation is entirely based on whether the practitioner is already intimately familiar with the client's internal ecosystem. SRE 2400 applies when a practitioner is hired to review historical financial statements, but they are not the independent auditor of that entity.
Got it.
SRE 2410, conversely, applies exclusively to the review of interim financial information when the practitioner is the independent auditor of the entity.
To lock that in, the shorthand we use is 2410 is for 10 and I.
Right.
10 meaning interim and I meaning independent auditor. SRE 2410 governs the interim review by the independent auditor.
The mnemonic is a helpful trigger. The 1 in 2410 points to the independent auditor, and the 0 maps to the O sound in interim.
2410 is for 10 and I. So if 2410 is the inside job and 2400 is the outside job, why do they require completely separate regulatory standards? Does the methodology change that much just because you are the regular auditor?
If we connect this to the bigger picture, the methodology shifts dramatically because of the practitioner's starting point.
How so?
Consider the reality of an SRE 2410 engagement. The practitioner has already conducted the grueling, exhaustive annual audit for this client. They've spent months mapping out the entity's entire control environment,
Identifying inherent risks.
understanding the IT infrastructure, evaluating the competence of management. They have a massive pre-existing foundation of knowledge.
So when they return 3 months later to perform an interim quarterly review under 2410, they do not need to rebuild that foundation.
Precisely.
They already know exactly where the internal control weaknesses are. They know which department struggles with revenue recognition.
Exactly. Their review is highly targeted. They focus on updating their understanding. What has changed in the last 90 days? Have you implemented any new accounting systems? Have there been any significant structural changes?
They can rely heavily on their prior audit evidence to inform where they direct their inquiries and analytical procedures.
Contrast that with SRE 2400. A company hires a brand new firm, someone who has never audited them, to do a review. The practitioner walks in cold.
They don't have that deep historical understanding of the internal controls.
Right, so SRE 2400 requires the practitioner to spend significantly more time up front obtaining an understanding of the entity and its environment, simply to be able to design effective inquiries and analytical procedures.
They have to map the terrain before they can look for anomalies.
It's the difference between navigating a familiar city where you know all the traffic patterns versus being dropped into a foreign city with only a high-level map.
Both require care, but the approach is fundamentally different.
This is why the standards are bifurcated.
That structural division is fascinating. It acknowledges the compounding value of an ongoing auditor-client relationship.
It really does.
So we've covered the baseline of zero assurance, and we've navigated the middle ground of limited assurance on historical and interim data. But we've spent all this time anchoring ourselves to things that have already happened.
Historical data.
Right. Here's where it gets really interesting. What happens when a client asks you to audit a crystal ball?
Yes.
We are moving up the trust ladder again into assurance engagements, and this brings us to SAE 3400, the examination of prospective financial information.
We are crossing a major philosophical threshold here. Everything we've discussed so far relies on historical fact. The transactions have occurred, the ink is dry.
Right.
SAE 3400 forces the practitioner to grapple with the future, with events that have not yet occurred, and critically might never occur.
It's inherently speculative territory. The liability risks must be astronomical. If an auditor puts their name anywhere near a document predicting future revenue and the company completely collapses a year later, the investors are going to look straight at the auditor and scream for accountability.
Naturally.
How does the profession even allow practitioners to provide assurance on something so nebulous?
They manage the risk by enforcing a rigorous taxonomy of the future. The standard does not treat all predictions equally. It strictly categorizes prospective financial information, PFI, into two distinct buckets.
Okay.
And the practitioner's approach must change entirely depending on which bucket they are examining. The two categories are forecasts and projections.
And mixing up these definitions is a classic trap, both in exams and in practice. If you evaluate a projection using the standards of a forecast, you are exposing yourself to massive legal jeopardy.
Absolutely.
The cognate hook we use to separate them is forecasts are facts almost, projections are pretend.
Forecasts are facts almost, projections are pretend. It captures the essence of the risk profile.
Let's unpack the textbook definition of a forecast.
A forecast is prepared on the basis of assumptions as to future events which management actually expects to take place.
Okay.
And the actions management actually expects to take as of the date the information is prepared. These are known as best estimate assumptions.
So it's an extrapolation of current reality. If a manufacturing company has been operating at 80% capacity and selling 1,000 units a month for the last 3 years, and they have signed contracts to maintain that, a forecast models that continued reality.
Yes.
It's grounded in empirical data. It's a fact, almost.
It assumes the continuation of the status quo with minor, highly probable adjustments.
And a projection.
A projection, on the other hand, is a completely different animal. A projection is prepared on the basis of hypothetical assumptions about future events and management actions, which are not necessarily expected to take place.
The what-if machine.
Exactly. What if we completely pivot our business model? What if we attempt to penetrate an entirely new international market where we have zero historical footprint? What if interest rates quadruple overnight?
These are hypothetical scenarios used to model extreme stress tests or radical shifts in strategy.
Yes.
Hence, projections are pretend. You are modeling a fictional universe to see what the math does. Now, why does this distinction dictate the auditor's behavior so strictly?
Because of the caveats required in the reporting. While a practitioner can never guarantee the ultimate accuracy of either a forecast or a projection, because no one controls the future,
Right.
the level of speculation in a projection requires extreme defensive signaling. If a practitioner is examining a projection, the standard mandates that their report must explicitly state that the PFI has been prepared using hypothetical assumptions.
Okay.
Furthermore, they must explicitly caution the reader that the projection is designed for a specific intended purpose, like evaluating a potential merger, and should not be used for any other purpose.
You are essentially putting a giant warning label on the report that says, this is a thought experiment, do not base your life savings on it.
Exactly.
Which perfectly segues into a massive ethical and regulatory hurdle, specifically in the context of Indian auditing regulations. We have to address Clause 3 of the second schedule to the Chartered Accountants Act, 1949.
This is where the theoretical standards crash into hard law.
Hey, Clause 3 is a fascinating piece of professional governance. It was designed to prevent chartered accountants from becoming financial hype men.
Yes. The clause states that a CA in practice shall be deemed guilty of professional misconduct if they permit their name to be used in connection with an estimate of earnings contingent upon future transactions in a manner which may lead to the belief that they vouch for the accuracy of the forecast.
It's an absolute prohibition. You literally cannot say, based on my expert analysis, I guarantee this startup will generate $50 million in revenue next year.
If you do, you face disbarment. It is professional misconduct.
So, if the law is that strict, how can a CA ever accept an SAE 3400 engagement? How do you provide an assurance report on prospective financials without violating Clause 3 and losing your license?
The Act and the standard provide a very narrow, highly regulated pathway to associate with PFI. A CA can associate their name with a forecast or projection, provided their report contains highly specific disclaimers.
Such as?
They must clearly indicate the sources of the information used. They must outline the basis of the forecast. They must detail the major assumptions made by management in arriving at the numbers.
Okay.
And most importantly, they must include an explicit, unequivocal statement that they do not vouch for the accuracy of the forecasts.
You have to explicitly tell the board of directors, the banks, and the investors. Actual results are likely to be different from the prospective financial information, since anticipated events frequently do not occur as expected, and the variation could be material.
Right.
You are providing assurance on the architectural integrity of the model, not the outcome. You are saying, if these assumptions hold true, the math is correct.
It is a delicate tightrope walk. You are providing immense value to the market by validating the methodology and the internal consistency of a forecast, while simultaneously insulating the accounting profession from the inherent unpredictability of the global economy.
It protects the profession from being scapegoated when a recession hits. All right, let's transition from the uncertainties of the future to the complex realities of modern corporate infrastructure.
We are moving to segment 4, which deals with trusting the middleman. This is SAE 3402, Assurance Reports on Controls at a Service Organization.
This standard is arguably one of the most vital for understanding modern audits because it addresses the reality of the cloud computing and outsourcing era.
Absolutely.
Let's contextualize this with a modern reality. Let's say you are auditing a massive regional bank. 10 years ago, that bank had a giant server room in its basement handling all of its core banking transactions, ledger updates, and customer data. As the auditor, you could walk downstairs, inspect the physical security of the server room, test the IT general controls, and review the disaster recovery protocols right there on site. The internal controls were entirely within the bank's four walls.
But today, that architecture is obsolete.
Right.
That same regional bank has likely outsourced its entire core banking infrastructure to a third-party tech giant, a service organization like Amazon Web Services, Microsoft Azure, or a specialized fintech provider.
The user entity no longer controls the physical servers or the underlying IT infrastructure.
And here is the auditor's nightmare.
Right. The auditor of the user entity, the user auditor, is legally required to obtain a comprehensive understanding of the bank's internal controls over financial reporting.
Yes.
But a massive chunk of those controls no longer exists at the bank. They are sitting in a heavily guarded AWS data center on the other side of the country. And AWS is certainly not going to let thousands of different auditors from every regional bank walk through their data centers to run individual tests.
It would be a security and logistical disaster.
So how does the user auditor gain assurance over controls they cannot physically touch or independently test?
Enter SAE 3402. This standard creates a mechanism for delegated trust.
Delegated trust.
Yes. The service organization, say, the specialized fintech provider handling the core banking platform, hires their own independent auditor. This is the service auditor.
Okay.
The service auditor conducts an exhaustive audit of the fintech provider's internal controls and generates an SAE 3402 report. The user auditor can then request this report and, based on its findings, determine whether they can rely on the service organization's controls when auditing the regional bank.
It's the ultimate professional middleman. But the notes highlight a critical distinction that completely dictates how much comfort the user auditor can actually take from that report.
Yes, there are two distinct types of reports under SAE 3402, Type 1 and Type 2.
And mistaking the utility of these two reports is a fatal flaw in audit planning. The mental model we need to lock in here is highly visual. Type 1 is a snapshot. Type 2 is a surveillance tape.
Let's examine the snapshot. A Type 1 report provides assurance on the design and implementation of controls at a specified date.
At a specified date.
The service auditor evaluates management's description of the system and tests whether the controls are suitably designed to achieve their objectives as of, say, December 31st. They will verify that the controls have been implemented.
It's a photograph. It proves that on December 31st, the fintech provider had a firewall installed, and the protocol stated it was active.
Exactly.
But it tells you absolutely nothing about what happened on January 1st, or what happened during the massive data migration in July. It provides no historical context.
A Type 1 report explicitly provides no evidence regarding the operating effectiveness of the controls over a period of time. And for a user auditor trying to assess the risk of material misstatement for an entire fiscal year, a snapshot is largely insufficient.
That is why they almost always require the surveillance tape.
The Type 2 report.
Right. The surveillance tape evaluates both the design and the operating effectiveness of the controls throughout a specified period. Usually this is a minimum of 6 months.
A Type 2 report involves rigorous, ongoing testing. The service auditor is pulling samples throughout the year to prove that the firewall wasn't just installed, but that it successfully blocked unauthorized access attempts consistently over the entire audit period.
It provides the empirical evidence of sustained compliance that the user auditor desperately needs to reduce their own substantive testing.
Exactly.
Type 1 is a snapshot, Type 2 is a surveillance tape. Now, I want to bring up an edge case here because the notes discuss a rule regarding Type 2 reports that seems incredibly unforgiving.
Which rule?
It's the requirement for radical transparency regarding deviations. The standard states that the service auditor must report deviations, meaning any instance where a control failed or did not operate as designed, even if the auditor ultimately concludes that the overarching control objective was still achieved.
It is a strict standard, but entirely necessary given the stakes.
Let's push on that. Suppose the service organization has a biometric security protocol for server room access. During the 6-month Type 2 audit period, the biometric scanner goes offline for exactly 30 seconds due to a firmware update. However, during those 30 seconds, there is an armed guard standing physically in front of the door, so the server room was never actually vulnerable. The overarching control objective physical security was maintained perfectly. Is there a materiality threshold, or does the service auditor really have to document a 30-second glitch in a formal report?
They absolutely must document it. The Type 2 report requires the service auditor to include a detailed description of the tests of controls performed, the sample sizes used, and the number and nature of all deviations noted.
Yeah.
They cannot bury the glitch simply because no harm was done.
Why? If the building was secure, why force them to air their dirty laundry?
Because the service auditor does not get to decide what constitutes an acceptable risk for the user entity.
Oh, I see.
A 30-second outage might seem trivial to the fintech provider, but what if the user entity is a high-frequency trading firm where millions of transactions occur every millisecond? For them, a 30-second vulnerability might represent a catastrophic risk of unauthorized data injection.
By forcing the service auditor to report every deviation, the standard empowers the user auditor to apply their own materiality thresholds
And make an independent, fully informed assessment of the risk to their specific client. It prevents the service auditor from acting as an opaque filter.
Radical transparency ensures the user auditor isn't flying blind. It's a brilliant system of checks and balances. We are entering our final segment now, moving to the pinnacle of complex financial abstraction, SAE 3420. Assurance engagements to report on the compilation of pro forma financial information included in a prospectus.
Pro forma financial information often intimidates practitioners because it deals with high-level corporate restructuring. But the underlying mechanic is actually quite elegant.
So what does this all mean? To demystify it, we need to understand what pro forma actually does in a real-world scenario. It is essentially a financial time machine. It is used almost exclusively in prospectuses when a company is attempting to raise massive amounts of capital from the public markets, usually in conjunction with a major event.
Let's give an example.
Sure. Let's imagine two massive rival telecommunications companies, Company Alpha and Company Beta. They announce they are merging to create a global monopoly. They need to issue a prospectus to raise billions of dollars to fund the integration.
The investors reading that prospectus have a specific problem. They can look at Company Alpha's historical financial statements, and they can look at Company Beta's historical financial statements. But those past records don't reflect the reality of the newly merged behemoth.
Right. Investors want to know what the combined financial health of the new entity looks like.
They want to know if these two giants had already been merged for the entire last fiscal year, what would their combined revenue, reduced overhead, and total profit have looked like?
That hypothetical combined financial snapshot is pro forma financial information. It illustrates the impact of a significant event on unadjusted financial information, as if the event had occurred at an earlier date. Management takes the historical data, applies pro forma adjustments like stripping out redundant management salaries or factoring in the new debt interest, and creates this new hypothetical financial statement.
And this is where the practitioner comes in under SAE 3420, and where a massive, dangerous misconception often takes root in boardrooms and among investors.
The misconception is that if a top-tier accounting firm signs off on the pro forma section of a prospectus, they are vouching for the accuracy of all the underlying historical numbers of both companies.
You're absolutely not doing that.
The mental model to navigate SAE 3420 is checking the math, not the past.
Checking the math, not the past. It perfectly delineates the practitioner's liability. Let's be very clear about what the practitioner is not doing. They are not responsible for compiling the pro forma information. That is management's responsibility. Furthermore, they are not performing an audit or review of the underlying historical financial information that feeds into the pro forma model.
So what are they actually giving assurance on?
Their sole responsibility under SAE 3420 is to provide reasonable assurance about whether the responsible party has compiled the pro forma financial information on the basis of the applicable criteria.
They are evaluating the process.
Did management correctly extract the historical data? Are the pro forma adjustments directly attributable to the event? Are those adjustments factually supportable? And did management apply those adjustments correctly to the historical unadjusted financial information?
Checking the math, not the past. If Company Alpha's management says, we are combining our revenue with Company Beta, and we are subtracting $50 million in duplicative marketing costs, the practitioner evaluates if that subtraction makes logical sense according to the regulatory criteria and checks if the spreadsheet calculates it correctly.
Yes. The practitioner explicitly assumes that the original historical revenue numbers provided by the companies were correct to begin with. They do not go back and re-audit Company Beta's past sales.
To protect themselves, the practitioner's report includes a highly explicit disclaimer. It states, the purpose of pro forma financial information is solely to illustrate the impact of a significant event. Accordingly, we do not provide any assurance that the actual outcome of the event or transaction at that date would have been as presented.
It's all about verifying the mechanics of the compilation.
But let's look at the friction point where this standard collides violently with securities law. The notes detail a scenario regarding modified opinions and prospectuses. What happens when the practitioner is checking the math and they realize the math is fundamentally flawed? Let's say management is aggressively manipulating the pro forma adjustments to make the post-merger company look artificially profitable, and they refuse to correct it.
Under normal auditing standards, if management refuses to correct a material misstatement, the practitioner issues a modified opinion, a qualified or adverse report. You state publicly that the numbers are wrong.
But in the high-stakes world of raising capital, securities regulators often have their own absolute rules. In many jurisdictions, the law strictly forbids the publication of a prospectus that contains a modified opinion on pro forma information.
The regulator's stance is essentially, if the pro forma math is materially flawed, it is too dangerous for retail investors to see. You cannot publish this document at all.
This creates an immediate collision between the practitioner's professional duty to report the flaw and the legal prohibition against publishing a flawed report.
Exactly.
So the practitioner needs to issue a modified opinion, but the law says a prospectus with a modified opinion is illegal. What is the practitioner's move?
The standard dictates a severe escalation. The practitioner must urgently discuss the matter with management and those charged with governance. They must explain that the pro forma compilation is flawed and requires adjustment.
And if management remains obstinate and refuses to amend the information?
The practitioner is left with very few options. SAE 3420 dictates that they must either withdraw from the engagement entirely, refusing to allow their name to be associated with the prospectus in any capacity, or, in highly complex legal jurisdictions, consider seeking independent legal advice to determine their next steps and potential reporting responsibilities to regulators.
You walk away, or you call your lawyers. There is no compromise. You cannot issue a clean opinion on manipulated pro forma adjustments simply to appease management and get the prospectus approved by the Securities Board.
It's the ultimate test of independence. It demonstrates that even when your mandate is as narrow as checking the math, your professional integrity and your willingness to hold the line against management pressure must remain absolute.
That is an intense way to round out the spectrum. We have successfully navigated the entire landscape of these dense textbook notes. We've moved from the zero assurance mechanics of related services through the limited assurance of reviews, all the way up to examining the hypothetical future and evaluating complex third-party infrastructure. Before we wrap up, let's consolidate the mental models we've built.
A final review of the framework.
Right. If you're prepping for an exam or stepping into a boardroom, these are the cognitive hooks to anchor your understanding.
For SRS 4400, agreed upon procedures, where we strip away subjectivity and execute the checklist. IROIC, inquiry, recomputation, observation, inspection, confirmations.
For SRS 4410, compilation engagements, where we format the data but don't investigate the underlying reality. Compile, don't profile.
When assessing the core methodology of a review engagement under the SREs, where we look for plausibility rather than proof. INA, inquire and analyze.
To instantly differentiate the review standards based on the practitioner's pre-existing knowledge. 2410 is for 10 for interim and I for independent auditor.
When dealing with the inherent risks of SAE 3400 and predicting the future, forecasts are facts almost, projections are pretend.
For navigating the outsourcing landscape of SAE 3402 and the reliability of service organizations, Type 1 is a snapshot, Type 2 is a surveillance tape.
And finally, for the high-stakes M&A world of pro forma information in SAE 3420, checking the math, not the past.
Embedding those frameworks will drastically reduce the cognitive load when you are faced with a complex auditing scenario. But the real value here goes far beyond just passing the CA final exam. Why does a deep understanding of these assurance levels matter to you, the listener, in the broader context of a professional career?
Because the modern economy runs on an overwhelming volume of reported data. Whether you are an auditor evaluating a client, a CFO deciding whether to outsource your entire IT infrastructure to a cloud provider, or an institutional investor analyzing a glossy 500-page prospectus for a leveraged buyout, understanding the exact level of assurance attached to the data you are reading is your only defense.
It is the shield against catastrophic miscalculation. If you conflate a compilation report with a full audit, or if you mistake a Type 1 snapshot for a Type 2 guarantee of operational effectiveness, you are building your strategic decisions on fundamentally flawed assumptions.
You have to know exactly how much structural weight a report can hold before it collapses.
And that leads to a final thought I want to leave you with. We've spent significant time analyzing standards like SAE 3400 and 3420 frameworks designed to govern human hypotheticals. These standards assume a world where human management teams sit in boardrooms, manually drafting projections and modeling pro forma adjustments. But the technological landscape is shifting violently.
We are rapidly entering an era where AI agents and complex neural networks can ingest a corporation's entire data lake and autonomously generate millions of hypothetical financial realities, dynamic forecasts, and instantaneous pro forma combinations in seconds.
It challenges the very foundation of how we assess assumptions. How does the auditing profession adapt to that? When the hypothetical assumptions aren't drafted by a CFO, but are generated by a black box algorithmic model that even its creators don't fully understand, how do you verify the basis of the forecast?
Will the global regulatory bodies need to draft an entirely new taxonomy of standards, perhaps an AI SAE to provide assurance on algorithmic dreams?
It's a horizon that is approaching much faster than the textbooks realize, and it's something every professional in this space needs to start preparing for.
The tools and the velocity of data will change, but the fundamental market demand for trust and for professionals rigorous enough to verify that trust will only become more critical.
The perfect place to leave it. Keep interrogating the data in front of you, always check the level of assurance, and keep building those mental models. Thank you for joining us on this deep dive into the architecture of auditing standards. We'll catch you on the next one.